Good morning or good afternoon, depending on where you may be joining us from, and welcome to Stop Tipping the IRS, Advanced Tax Strategies Your CPA Isn't Telling You About. This is installment number 2 in our 12-part series where we teach business owners how to maximize their net proceeds when it becomes time to sell and exit the business. A quick question though before we get started. When was the last time your CPA called you proactively, just sort of out of the blue, to tell you about a tax strategy that could save you money on next year's taxes and years beyond? If the answer is never, or you cannot remember, you're not alone. And that's not necessarily a criticism of your CPA. It's actually the point of today's entire conversation. My name is John Heck, and I'm a financial strategist, and I have spent decades working with business owners who are doing everything right on the surface, and still they're overpaying their taxes by a significant margin. Let me tell you exactly who this webinar is for. If you own a business generating anywhere from $2 million to $20 million in revenue, if you have a CPA that you trust, and if you have not had a dedicated conversation about tax strategy in the last 12 months, you're in the right place.
Perfect. And so before we go on a single step further, here is what I want you to understand. We have two goals today. The first goal is to teach you something that you may not have known about your business or taxes, something that you can take away from this conversation and apply immediately to the way that you think about your tax situation. The second goal, if we do what we say we're going to do and cover the material we say we're going to cover, I'm going to ask you to book a call with us. Not to sell you anything or pitch you anything, but just to have a real conversation about where you are specifically and how you might be leaving money on the table. So that's the deal that we have. And we want to be upfront about it because we want to respect your time, and obviously we respect ours.
So a couple housekeeping items before we go any further. The bean counters and the suits would like me to remind everybody that everything we discuss here today is educational in nature and is not intended to be specific financial, tax, or legal advice. Your situation has details that are obviously unique to you and your business, and anything we cover here should be reviewed with your personal advisory team before you act upon it. In addition, any client names used in this webinar is purely fictional, and all specific dollar amounts mentioned are for illustrative purposes only, and they should in no way be interpreted as typical results. Actual results may vary on your own specific situation. Miles per gallon may vary as well.
I know I've said that, we really do need to speed that, like the end of commercials, like here's the side effects. So now that part of that's out of the way, and trust me, there'll be more compliance things as we go along this, but here is what today is not. This is not a webinar about offshoring accounts or aggressive shelters or anything that will make your accountant nervous. This is about legal, documented, and well-established tax strategies that most business owners simply never get introduced to. And the reason you have not heard about it is not because they're exotic. It's because of a structural gap in the way most advisory teams are built. And that is exactly what we're going to talk about and show you today. Now, I know some of you are watching this and there's questions in your head and there's some misconceptions and preconceived ideas before we even jump into what these tax strategies and lanes are. So I want to put them on the table so we know exactly what they are. And we're coming in this with open minds and ears. So one of the first objections we hear, and it's really across the board, is my CPA handles this. The reality is, and the hard truth is, your CPA handles compliance. They are happy historians, most of them. They file your taxes. They make sure that you meet the deadlines on your annual and quarterlies, and they make sure the numbers are right. And that is a very critical and important job for them to do. And it is a completely different job than an actual tax strategy. So those two things are not the same. We want to be very clear about that. We will show you exactly why they're not the same in a few minutes here.
And objection two is usually something like, hey, John, I don't want to trigger an audit. This all sounds great, but I don't want the IRS breathing down my neck. These strategies that we're going to talk about today, these are not audit triggers. They are established provisions within the current tax code. The IRS wrote these rules in for a reason. And we're talking about whether you're using them or you're not using them to your advantage. There's a meaningful difference between aggressive tax avoidance and deliberate tax planning. We're going to talk about deliberate tax planning today.
Objection 3 here. I trust my CPA and we have a good relationship, and that is fantastic. I hope you have a great relationship with your CPA. Nothing we say today changes that. In fact, the work we are going to describe typically happens alongside your CPA, not instead of them. And so the question is not whether your CPA is good at their job. The question is whether their job description includes what we are about to show you.
And sometimes people will say to us, some of this probably doesn't even apply to my particular situation. And that may be true. Some of the 4 areas that we'll discuss today may not be relevant to your specific business. But in our experience, most business owners say that they've never heard of someone actually, they've never heard, never had someone actually take a look at these strategies. So what they're really saying is, I don't actually know if these apply or not. So there's a big difference between does not apply and no one's ever checked it.
Huge. And before we jump into this, the framework, John mentioned a little bit about himself. My name is Mike Clark. I'm also a wealth manager, and I help business owners build these coordinated financial teams. It's not a collection of individual advisors who each do their piece and then go home. A team that actually works together so nothing falls through the gaps. And what I've learned from the years of those conversations is that the advisors who are supposed to be working for you are rarely working with each other. And when a question crosses these disciplines, the answer is almost always, that's not my area. And so it ends up being that nobody really owns the whole picture. And so just as a quick story here, a partner of mine, a financial strategist that I've worked with, was working with a client and actually identified about $60,000 in tax credits that we're going to talk about here in a second. And the money that this client was eligible for, and there's legitimate credits documented in the tax code. And my partner brought this to the client, who took that to their CPA. The CPA's response was, if this were real, I would have told you about it. Now, my partner provided specific tax code references, documentation, the full works in terms of supporting his position and the money that this client was eligible for. The CPA still said no. Not because the credits were inaccurate, because the CPA felt that if it were real, he would have known about it already. Now, the client walked away from roughly 60 grand because their CPA's ego, and yes, it was their ego, was more important than the client's outcome. And the question that I couldn't get out of my head is that if the CPA did this for this client, what other client is missing opportunities because the CPA doesn't know about it? And so that was really the moment that I decided to become this financial quarterback, which, that person that helps bring the team together. So we're not just filling out paperwork, we're actually building a plan that is in line with your business.
And like I said earlier, my name is John Heck. Like Mike, I too am a wealth manager. For more than 35 years, I've spent that time helping my clients acquire, protect, and transfer wealth. I tell people all the time that I'm a terrible salesperson, but I'm a very good educator. In other words, I'm very good at translating complexity into a process that business owners can understand, follow, and act upon. My role in that situation is to translate what the tax code actually makes available to you in plain language and with a clear process so you can make informed decisions with your CPA. And I'd like to add, I'm not here to replace your CPA. I'm here to make sure that you and your CPA are getting the full picture.
So here is the thing about the way most business owners think of their taxes, right? They've got this simple scorecard and it has a couple things on it. Did we file on time? Do we owe money, or are we getting a refund? And did anything bad happen? And if the answer to those three questions is yes, no, and no, right? They call it a win. And I consider this to be kind of a compliance scorecard. It tells you exactly one thing, and that is whether you followed the rules. It tells you nothing about whether you paid more than you had to.
Let me underscore that compliance means you met your legal obligations. Tax strategy means that you've used every legal provision available to minimize what you owed to the IRS before you arrived at that compliance number. See, most CPAs are optimized for the first task, the first job. The second task or the second job requires a different lens, a different set of skills, and a different specialist in most cases. And in most cases, different questions being asked throughout the year, not just at tax filing time. So let me just say that again because it's critically important. Different questions being asked throughout the year, not just at filing time. Oftentimes at filing time, some of these strategies it's too late to take advantage of.
100%. And so here's what I want you to consider in the time that we have together here. What if the reason you are paying what you're paying in taxes has nothing to do with your revenue, your industry, or even maybe the company structure? What if it is simply that nobody on your team has been assigned to look for the opportunities in terms of what you're eligible for in terms of the tax credits? And so what we're going to walk through today is what we call the 4 tax lanes. Each lane represents a distinct area of legitimate tax strategy. Lane 1 is where every business owner plays. Hopefully, you're paying your taxes. Lanes 2, 3, and 4 are where the opportunities typically live. But before we go any farther, I want to ask you something like directly. If we can show you specific areas of the tax code where business owners at your level are regularly leaving money on the table, would you at least consider taking a closer look at your situation? Because that's all we're asking. We're not asking you to change your business. We're not asking you to change the professionals you work with. We're just asking you to consider the option that this may be available for you. So if you're open to it, let's get into this.
All right, perfect. So let me describe 2 different business owners. They both have similar revenue. They come from the similar industries and similar growth trajectory. The difference here is entirely in how they approach their tax situation. So, profile number 1 is what I like to refer to as the default position. This owner has a CPA that they've worked with for years, returns are filed on time, no audit history. But when they ask the CPA at tax time, am I paying too much in taxes? The CPA typically will say something like, you're paying what you owe. And that answer is accurate, it's truthful, but it's strategically incomplete. What I mean by that is this business owner's advisory team works in what we like to call silos. The CPA, the attorney, and the wealth manager each do their job, but no one is coordinating across the disciplines. Nobody's asking the question that lives in the space between all 3 of those silos.
And here's what this first scenario does not know. They don't know what lanes 2, 3, and 4 look like on their return. And it's not because they're not smart. It's because, to John's point, nobody ever showed them. And because the person who files their taxes was hired to file their taxes. They're not hired to redesign and actually put together a strategy to make the tax more efficient.
Profile number 2 is what we call the coordinated owner. This owner has the same CPA, but he also has a strategist in his corner who is actively looking at all 4 lanes throughout the year and across the space that exists between the three disciplines. And they have, so in other words, this owner has a coordinated team. Questions that cross the disciplines, they get answered, not deferred to someone else. When the opportunity shows up in the tax code, there's someone whose job it is to bring those ideas forward.
Now, just to be clear, the second profile is not a large company, this massive conglomerate. They're not paying for a team of lawyers. They simply have made one decision that profile one has not. They decided that tax strategy is a year-round strategy, not a once-a-year filing event. Because here's the truth. If you have never been introduced to lanes 2, 3, and 4 that we're going to introduce here in a second, you are in profile 1. And that's not a character flaw. It is a gap in your advisory team. And obviously a gap that needs to be addressed, and one that we'll talk about. So let's walk through these 4 tax lanes. And I want to be kind of clear about what each one is and what it is not.
So lane 1 is compliance. This is the foundation. Accurate financial records. I like to say that this is the recording of tax history, what's already occurred. This is things like on-time filings, meeting your legal obligations. Your CPA lives here in this environment, in this world. This lane is not optional, as you're well aware, and it's not where we're going to spend a lot of time today, because you probably have this covered already. But it's important to understand it, because lanes 2 through 4 sit on top of this foundation. And if lane 1 is not a solid foundation, nothing else matters.
I mean, at least I hope everybody's paying their taxes. Please do, if you're not. Because to John's point, lanes 2, 3, and 4 are where most business owners have never had a professional look.
And lane 2 is tax credits. The tax code contains a significant number of tax credit provisions that business owners may qualify for based on activities that they're already engaged in. And the most commonly overlooked, and there's others, but the most common is the research and development credit. Okay, and it's worth noting here that research and development, or R&D as it's sometimes referred to, this does not mean that you're running a laboratory. Of course, your business may be running a laboratory, but that's not the point. It means that your business is engaged in documented activities to improve a product, a process, or a piece of software. As an example, you might be running a manufacturing company that refines their production process. You may qualify for these credits. Technology company that develops internal tools may also qualify for these credits. In many cases, the activities are already happening within the business, and the credit has simply never been claimed before.
Dollars. That is what that CPA told my partner's client was not real. And it is real. And you may be eligible for these credits that nobody is telling you about. So it is sitting in lane 2 the entire time. You just have to ask.
Yeah, that's a lot of money to leave laying on the table. Lane 3 is depreciation and cost segregation. If you own real property, for example, a factory, a warehouse, an office building, maybe a medical facility, retail space, there's a likelihood that you're depreciating it on a straight line schedule over 39 years. So a cost segregation study can accelerate a portion of that depreciation into the early years of ownership, which generates substantial deductions in years 1 through 5. Let me give you an example here. Let's say you have a facility that has a customer-facing showroom, and that showroom has carpet on the floors. Well, if you're deducting or depreciating that carpet on a 39-year schedule, which you might, in most likelihood, are doing today, there's a very high likelihood that you'll have to replace that carpet multiple times before the 39 years is actually up. The IRS allows you to depreciate that that element, that carpet in this example, and it could be anything else, plumbing, electrical, fixtures. It allows you to depreciate that. This is not a gray area. The question is whether it has been analyzed for your specific property yet.
Which is very interesting because, lane 3 is where I have seen business owners recover the most in the shortest amount of time. And it's not because it's complicated, uh, because it requires a study to be done that most owners have never been told to actually get done.
And lane 4 is entity structure and SALT planning. So, how your business is structured. In other words, is it an S Corp, a C Corp, an LLC, a partnership, or something else? That has a direct consequence for your tax liability. And so does where you operate and where you're domiciled. As your revenue grows, the structure that you started with, it may or may not be the right one for your situation. And the SALT aspect, which stands for state and local tax, becomes increasingly relevant as businesses operate across state lines or consider relocating. These decisions have very real consequences that compound over time.
Right. So, as a practical example, business owner restructures from an LLC to an S corp at the right revenue level, and this happens all the time, and it may reduce their self-employment tax exposure in a meaningful way on that income that they're already earning. But nothing about the business has actually changed, only the structure. So lane 4 is the lane most people discover last, and it's usually right before they're about to sell, which is not the opportune time. But this framework, these 4 lanes, and one is covered. The other 3 are likely not covered at all, but you need to start asking about these for your business.
So here's an example of what Mike's talking about. Greg is a business owner. He owns a manufacturing company, and he's generating about $3 million in annual revenue. His CPA has been filing his returns correctly for years, but nobody on his team has ever looked at lane 2. And when a tax strategist completed a preliminary R&D credit analysis, they identified approximately $180,000 in credits from activities that Greg's team had already been conducting. Process documentation, tooling, adjustments, quality control testing. The activities I'm talking about were not new to Greg. They had simply never been captured or categorized correctly. The work to claim these credits involved documentation and coordination between Greg's operations team and a qualified specialist. Of course, it's not trivial, but it wasn't a fundamental change to how Greg ran his business. He was already doing these things. The money was already there. It just needed somebody looking for it and taking advantage of those credits.
I mean, think about that. Greg spent years walking past a significant credit, $180,000. And it's not because of anything he did wrong. It's to John's point, because nobody on his team had ever been given the job of looking or took the responsibility of looking, right? So another example here is Sandra runs a distribution company and owns the building she operates her business out of. And she's owned the building for roughly 6 years. And for 6 years, she had been depreciating, to John's point earlier, on a straight line schedule over 39 years. And that's, like we said, pretty standard, right? And if you're able to, it's what people do. But the cost segregation study identified approximately $200,000 in 1 year, accelerated depreciation that she had not taken in previous years. And so Sandra obviously didn't get the check in the mail, but what she got was a significant reduction in her taxable income in year 1 of the study. So she used it to actually fund a retirement, which is pretty cool, that she's been putting off, setting up for years. That building was not new. The tax code was not new. The only thing that changed was that somebody finally looked. And I know we've said this time and time again. It just takes you looking and asking for you to get these benefits.
And once again, Sandra's CPA was not doing anything wrong. The return was accurate. The question is whether the CPA's job description.
So I want to do something right now. You're watching this recording. It doesn't take very long. There are 4 questions, one for each lane. And so as you sit here watch this, I just would ask you to answer them honestly. Obviously, we don't know the answers, but they're designed to go to your professionals and start asking. So the first question is, and I think John mentioned this earlier as well, has your CPA proactively identified any tax credits specific to your industry, whether that's R&D, energy, work opportunities that you may be eligible for? Have they said anything in the last 3 years? Yes or no? Question 2, do you own any real property, a building, significant equipment, commercial improvements that have never been analyzed for accelerated depreciation? Okay. Question 3, has anyone on your advisory team reviewed your entity structure in the last 3 years with tax minimization as a specific goal? And question 4, if you moved your business or personal domicile to a lower tax state, do you have a clear picture of how that would affect your tax obligation moving forward? So if you answered no, or I don't know, to any of these questions that I just asked, then that lane has not been driven forward. There is at least one area of your tax picture where nobody has looked. So, let me kind of bring this together and talk about what we've covered here. So you came in today with a CPA. Our hope is that you're leaving today with a different question. So the question is no longer, is my tax return correct? The question now moving forward is, which of the 4 lanes have I never had someone look at? And lane 1, you're filing taxes, so you're covered there. Lanes 2, 3, and 4, we've talked about. Most of you have at least one of these lanes that has never been examined. And this is not a criticism of your CPA. It is not a criticism of you as a business owner. You're running a business, you're busy. It is a description of the gap that we talk about in every one of these webinars. Understand that these are the most talked about credits in the market right now, and yet very few people take advantage of them. And just to kind of put this in perspective, there are dozens of opportunities in the tax code that you may be eligible for. We can't go through all of them, but you just need to push to get the right answers. Now, those are big numbers. And even if you're on the lower end, here's what I want you to sit with. This is not a one-time number. That is a number that compounds every year you do not look at it. Every year you close your books without asking the 4-lane question is a year that cost you something. And that is not next year's problem. It is this year's problem. It is this year's cash flow problem, not last year's. Although you can go back years to look at some of these credits, but it also compounds moving forward. So here is where I want to be extremely direct. You have the framework now. You answered the 4 questions, If any answer was no or I don't know, there is your opportunity. There is the opportunity to take advantage of the tax credits. That is the opportunity to ask the question and have somebody look into this so you can benefit from these credits. So with that being direct, we started today. I told you that we had two goals. Hopefully, first goal was to teach you something real. And if we delivered, we were going to ask you to take a next step. And I hope that we did deliver. And now I'm going to hold up my end of the deal here. The next step is a complementary value gap assessment. And so before I tell you what that looks like, I mentioned compliance at the beginning. There is a little bit more compliance that we have to talk about, but it's also get some clarity so you know where we're coming from. Awesome. So here, the conversation is just that, right? It's not a sales pitch. It's about an hour long. We're going to ask some questions about your business, its structure, what your advisory team looks like, and which of the 4 lanes you have and have not addressed. Look, we are not analyzing your financials on this call. We are getting to know your situation well enough to determine which of our strategic partners is a right match for you at the time of the conversation. And we're going to go through stages of this. But when you leave that conversation, you'll know who you should be talking to next. And most oftentimes, we'll be able to schedule those calls with those partners right then so you don't get lost in the mix. But that's what the conversation focuses on. Absolutely. So if that sounds like a conversation worth having, then I would ask you to scan the QR code that you see on the screen. It takes 2 minutes to get it scheduled. And I'll tell you that there's no preparation that you need to be on that phone call. We're not analyzing any financials. Just show up and be ready to talk about your business. If you came in today as the first profile that John talked about, then this conversation starts changing that in a direction that benefits you and your business. And then as we wrap up here, I just want to remind you, this is a 12-part series. John mentioned it. I want to say it again. The next webinar we're going to talk about is a great topic, something that I've learned a lot about in the last 2 or 3 months. It's about deferred sales trusts. So if you're thinking about eventually selling your business, which you should be, and want to understand how to defer those capital gains tax on that sale, you'll want to be in that room. So we'll drop the registration link in the description below. It'll be on LinkedIn again. But if you have any questions, put them in the comments below. We'll get to those questions. Awesome. So with all that, John, thank you. I appreciate it. I know you're on location today, but everybody, thank you for being here. Please drop your comments, like, share the video if you know somebody that this would be a benefit for. We will see you in 2 weeks.